Hooray, I'm back. It's time for a little bit more of Module 1, Accounting in Context. And so at this point, we're heading into what I think is kind of a key element, because we're going to actually talk about financial statements a little bit, make sure people are up to speed with that. Before we get to the financials, though, I always think about this model. Okay, so you've probably heard of Peter Drucker, and Drucker's point was business, that's easily defined. It's other people's money. And so you want it, okay, other people have it. And so to me, when I think about this course and the ventures that people might want to pursue, it's all about the cash, okay? And you're trying to figure out three things. One, how do I get it? How do I use it? And very importantly, how do I keep it? So that's kind of the goal. And so accounting can help you think about that in context of, how do I get it? How do I use it? But also, how do I keep it? And so let's see how the financial statements contribute to what we understand about that idea. And so the first thing we've got is this accounting equation. So look at this first. Don't be intimidated by the giant amount of stuff on there. So, as you have probably heard before, assets are always equal to your liabilities plus equity. Okay. So, assets are those things that you own, okay, that you can use to meet your obligations. The liabilities, okay, are what you owe others outside of like suppliers and customers and banks. Equity is what you have available inside of your organization through earnings, through investors, and that sort of thing, available to acquire more assets. So this one comes from external parties. So that's external financing. This is internal financing. So don't forget those two pieces. So both of these work together, if you will, to be able to generate our assets and grow the company. So at this point, we also need to think about what are the underlying categories, because if I just told you here are all the dollars in one spot, okay, that's not really helpful. So how do I categorize these things? Think about it like fantasy football. If I just gave you statistics from all the players without names and positions, it'd be very difficult to kind of pick a team. And so if at least if I know who the quarterbacks are, who are the running backs, who are the receivers, then once I have those categories, I can make more informed decisions. And so under assets, we typically talk about two major categories. One, current assets. Those are assets that we could turn into cash within 1 year. You'll hear people sometimes talk about an operating cycle. These things are, you're capable of turning those things into cash inside of a year. Then you've got those that aren't, okay, non-current assets. Inside of current assets, cash, receivables, I think, that's what customers owe you for things they've purchased. This is also a strategic decision on your part. To what extent do you want to offer credit to these to customers to get the sales done? We'll talk about that later. Investments, where do you park your funds available to generate interest income, dividend income? Inventory, what do you keep around to meet your customer demands? And then there's everything else. There's always an everything else in accounting. The question is, how much do I want to aggregate my information? And so it all comes down to, is the information helpful enough that users will use it? Okay. If I'm a user, if I'm a bank looking at your financial statements, I want to know what cash you have on hand. What do customers owe you? Do you have any other investments outside of this that you might be able to use for collateral? Do you have any inventory? The rest of it, I may not be that interested in. These things I can actually see and understand. What else is non-current? Well, property, plant, and equipment. Okay, uh, accountants call this the original PP&E, personal protective equipment. Not really. This is um, just the assets that you have, like a building or the equipment that you have, leasehold improvements, all those things kind of go in there. The intangibles, the old joke is this is, if you're old enough, this is the MC Hammer piece. Can't touch this. These are intangibles in the sense that they're patents, um, uh, copyrights, those kinds of things that have value to you. That you acquired in some way, but there's not a physical presence of those things. And then other long-term assets, these are usually assets not being currently used in operation of the business. So for example, Walmart always had a lot of other long-term assets because they would go out and try to buy land where they would ultimately put in a facility at some point, but they tried to buy those years ahead of time so that they wouldn't get into a situation where people driving up the price on some of this property before once they heard that Walmart was coming in there. So because it was not as part of their operating activities at the time, they had to put it down here in long-term assets because they owned it. It had value. It's just not something that they were using in the near term. Liabilities, there's two kinds. There's current and there's long-term. The currents tend to be accounts payable, stuff I owe my suppliers. There's this current portion of debt, okay? LTD is long-term debt. It's the portion I owe in the current period, okay? So this is going to be related to this, but they separate it out in the context of what's current and what's long-term. Then you have all the other things, like taxes payable or payroll payable or some of those kinds of things, but they tend to be small compared to these two. And then finally, you've got your debt. You've got this thing called unearned or deferred. Some people, more recently, this is called deferred revenue. This is like deposits that you might have, or if people pay you in advance for a membership to something. It's not all sales to you immediately or revenue. You have to earn it over time. And so we'd park that as a liability, an obligation that you have to some other group based on the performance of the services that are going to be required. And then you got the other stuff. Okay, again, there's always other stuff. Finally, the equity piece. This one tends to be a little more confusing, so we have to be a little careful here. And so in that, we've got some common stock and preferred stock. For most people who are just getting a business started, they may not be stock driven. They may be much more of a sole proprietorship. Almost certainly they don't start with preferred stock, okay? But this is a way for money to come in for investors if they can get some ownership in your company. Retained earnings is one of those strange terms that reflects what kind of profit have you retained inside of the company for use in growing your assets. So this is a source, another source of self-funding of asset growth. Now, that retained earnings can be reduced for a couple of reasons. One is if you did have stock and you chose to buy it back so that you reduce the number of people who had ownership of your company, you could buy back treasury stock. Okay, that would reduce your retained earnings. You can also pay dividends. Okay, so that's another piece. Finally, the big thing that tends to throw people off is the other way you improve your equity is by generating income. So the income from the current period gets added to equity because it's ultimately going to wind up increasing our retained earnings. And so don't forget that this amount, this current period income, is made up of sales and expenses, but that is your income statement connection. These things are your balance sheet items. These things affect the balance sheet because they hook into retained earnings, but they're also shown, because I want more information about this, they're also shown in the income statement. So with that, I think we've used our time for this particular component, and I'll see you when we actually look at some financial statements in our next video. Thanks for coming. See you later. Take care. Bye.